Despite all the expectations of tapering and normalization of US monetary policy, my base case is we're going to remain in a QE world. So what I said in my most recent quarterly, I said investors were surprised by the Fed's failure to taper in September, since they still believe that the American economy is normalizing. This optimism remains misplaced. 5 years after the Lehman bankruptcy, the pursuit of unconventional monetary policy is more entrenched than ever, while the global trend remains deflationary. Second point, if investors ostensibly hope for normalization, the alarm shown by markets last quarter at the mere hint of Fed tapering shows the extent to which investors, especially leveraged investors, have become addicted to the fix provided by unconventional monetary policy. This is why any attempt to exit from quantitative easing is likely to be short-circuited by withdrawal symptoms resulting in no exit. So in my view, you should view the QE habit as the equivalent of a heroin addict. The markets have become addicted to QE. Therefore, when the markets thought QE was ending, they freaked out, and so the tapering concerns are the financial equivalent to withdrawal symptoms. So bottom line, the QE is continuing, and in my view, QE is good for asset prices but not good for the economy. So definitely QE is helping the US stock market. You can see chart 4, this is the history of the S&P with the Federal Reserve balance sheet expansion. The 2 times that the Fed stopped QE since 2009, the market went down. When the Fed resumed QE, the market rallied. This year, 75% of the increase, about 75% of the increase in the S&P is driven by PE expansion, not by earnings growth. In terms of whether it says works for asset prices, but in terms of whether the US economy is getting credit traction, so whether the credit multiplier is coming back, I remain skeptical. Bank loan growth in the US has been decelerating for the last 18 months. So bank lending grew at only 1.9% annualized in the most recent data we've got. Bank revenue growth is running at only 1% since 2009, lowest annualized growth in bank revenues since the 1930s in the US. Velocity of money in circulation is still trending down. And the Fed's favorite inflation indicator, core PCE deflator, grew at only 1.2% annualized in September, which again is well below the Fed's inflation target. So the bottom line is I'm expecting us to remain in a QE world, and the other problem for America is increasingly uneven income distribution. So the top 1% of Americans accounted for 19.3% of total household income excluding capital gains in 2012, the largest share since 1928. Your average American is seeing income growth in October of 2.2% annualized. So it's picked up from the lows, but income growth in the US is still relatively low. Real median household income has been declining in the States for several years. And for 42 consecutive months, the number of Americans leaving the workforce has exceeded the amount of jobs being generated. So the bottom line of everything is the US economy is growing at a trend rate of about 2%. It's not a disaster, but it's not strong enough to get the Fed to normalize monetary policy, given the people running the Fed, and Mrs. Yellen is at least as dovish as Mr. Bernanke, if not more dovish. So that's the view on the US. Eurozone, we are in an ongoing deflationary adjustment reflected in a rising current account surplus. But the problem for the Eurozone is that this deflationary adjustment is driven more by weak imports than rising exports. So it's more of a bond bullish story than an equity bullish story, and bond yields in the Eurozone periphery continue to come down. Cyclically, I think the Euro GDP data is stabilizing, but I'm not expecting a big acceleration in GDP growth in the Europe, and you can see loan growth is still negative. Chart 20. Best growth story in the Eurozone is German residential property, which is booming, driven by negative interest rates in Germany and the fact that Germans don't trust the euro anymore, so they rather buy real assets. Going away from Europe, this is the year when the commodity trade decoupled from the risk-on trade in equities. You can see equities have continued to go up. Commodities have come off because the China-driven investment boom has peaked out. You can see emerging markets continue to underperform the S&P. Why are emerging markets underperforming the S&P? In my view, primarily because emerging markets don't have QE and the S&P does. Also, nominal GDP growth in Asia has been going down in most countries, chart 24, including here in India. The other point about Asia is we don't see clear evidence yet of a pickup in Asian exports. This is Asian export growth, and I've got 4 manufacturing-orientated Asian economies here: Korea, China, Taiwan, Singapore. We don't see clear evidence of an export pickup. I've got various charts on my portfolios, which I'll be happy to discuss if there's the interest. I'll just run quickly through the Indian charts. So this chart shows the sharp slowdown in Indian GDP growth since the bounce off after the end of the financial crisis. In my view, the key chart in India is chart 34. That's the investment cycle. So India, in my view, was the best equity investment story in Asia between 2002 to 2009, because we had this ongoing very rapid investment cycle, and it's that investment cycle that drove the stock market. Since then, the investment cycle has been coming off, and basically the Indian story is not a great investment story again until we see hard evidence that this investment cycle is resuming. If and when the investment cycle resumes in India, it has potential to become the best equity investment story in Asia again, but this is not yet the case. Growth in value of investment projects. We don't see any evidence as yet in this chart of a pickup, chart 35. And chart 36, this is new projects announced. We see a slight evidence of a pickup, but it's still very marginal. So hopefully if this investment cycle is at the bottom, it won't get any worse, but we're not seeing clear evidence of a pickup yet. The current account remains very negative. Because the economy is slowing, I would expect the current account deficit to improve. But the key issue for me is not the current account deficit. The key issue is when the investment cycle picks up. The rupee is now quite cheap, so that's a potential positive for investors. And inflation there remains quite sticky. CPI is higher than WPI, and there's clearly a risk of more rate hikes. So I think the Indian macro story and credit growth is clearly now slowing in India, chart 41. The one big positive for India is that foreigners have never sold down their Indian equities, which is remarkable. Growth's gone from 9% to 5%. ROE of the stock market is halved, but foreigners have continued to be net buyers of Indian equities. So this year they bought a net 16.7 billion worth of Indian equities so far this calendar year, and a net $87.6 billion of Indian equities since 2009, even though the economy's been slowing since 2009. So the rupee would have weakened a lot more if foreigners had not maintained their holdings, but foreigners tend to own expensive quality stocks, and the high valuation of the Sensex is somewhat misleading, because a lot of Indian stocks are way off their highs, even if the Sensex is near its highs. But the one thing that hasn't happened in India, which could have happened during this economic slowdown, is foreigners quitting the market. As in terms of India's relative performance in an Asian portfolio, India has been tending to underperform in recent years. And my confidence that India can resume outperformance in Asia will really hinge on whether India gets an investment cycle back. And I think because of and clearly this whole issue whether India gets an investment cycle back is wrapped up with the forthcoming Indian election. So I would say the forthcoming Indian election is going to be the most important political event for investors in Asia next year. Because the perception of investors is that the collapse in the investment cycle in India is partly driven by government policy. Therefore, the perception is that a change in government policy could create a revival in corporate confidence and therefore potential greater chance that an investment cycle resumes.